Hi, my name is Roy Rumbo. I'm an accounting professor with the University of North Texas. And today I'm going to be talking about, my God, one of my favorite subjects for two reasons. One, I love the cash flow statement, and we're going to talk about the cash flow statement. Second reason, this is chapter 21 in the McGraw-Hill, Spiceland, Nelson Thomas Intermediate Accounting textbook out of 21 chapters. And I now have lectures for all 21 chapters sitting out on YouTube, primarily for the benefit of my Intermediate Accounting 1, Intermediate Accounting 2 students. But certainly at the end of this lecture, I'm going to have a small celebration to be done. But I know your work is just beginning. But if you made it here and you've been watching me for 21 chapters, oh my God, I hope you got some good sleep out of those. But I would do these even if I just helped a few students. And so, obviously they're there for my students primarily, but I have had comments from other students, even from as far away as New Zealand, and different people that somehow, everybody's teaching style works differently for different people. And so I had a long experience as chief accounting officer of two public companies over 15 years, seeing all these materials can provide a story here and there, sometimes too many stories probably, and the lecture becomes too long, but it is what it is. And so today I'm going to talk about the cash flow statement. And so with that, I'm going to share my screen here on Zoom and get started. So chapter 21 of 21 chapters, we are at the end of the road for intermediate accounting. And, intermediate accounting, it's like 100% of intermediate accounting is on the CPA exam. There you go. And then about 90% of the financial reporting section is from intermediate accounting. So this is really important materials for people. And so hopefully you guys are all going to go after the CPA exam. Really matters a lot. I value my CPA. I'm also a CMA, but I really value my CPA. So, but I'm also an investor, and as an investor, there's information on the cash flow statement that you don't see elsewhere. So it really supplements the income statement, the balance sheet, and the cash flow statement. For me, it all kind of comes together on the cash flow statement. And in class, I've had students yell out the name of a company. I'll go pull up their financial statements and tell the story of companies I don't know, a lot about, but the financial statements tell a story. And the big piece of the story is right here in the cash flow statement. And the second thing I would say is I want my students to leave my Intermediate Accounting 2 class with the ability to do a cash flow statement. So in the part B of this lecture, I will work 4 or 5 financial cash flow statements. And I've had a student who went to interview right around the time they were taking my Intermediate 2 class. And they said, Professor Roy, they asked me if I could do a cash flow statement. And I said, yes, I can. And they ended up doing a lot of cash flow statements. And so they're very grateful that I was able to help them. Now, obviously, in some companies, the financial statement, the cash flow statement could be a little more complex, especially if you have currencies involved, than what we cover here. But the basic way and methodology for doing cash flow statements is going to be right here. So with that, let me stop talking and get started. So here are some of the usefulness, and I see this. Hey, you're going to take the cash flow first of all here, and all the cash in and cash out for the whole accounting period, and you're going to break it into operating versus investing versus financing activities. And so those activities are going to really help you to see. So what kind of, how much is the company investing? How is it investing? How is it being financed in the financing section? Hey, are they acquiring facilities in the investment section? You can see that. Or, are they selling a lot of facilities? But if they're buying a lot of facilities and you see a lot of cash use in the investing section, hey, might be a good company to invest in. Maybe they're growing. They're going to have higher income in the future. And how about the cash generated from operations compared to net income? That could give you a feel for the quality of the accounting at times. And you can answer some questions about retained earnings. I would say the cash flow statements where I see how much dividends were paid, because in the investing section it would be cash paid by dividends. A lot of times I will compare the cash outflow for dividends compared to the cash hopefully inflow from operations and see, hey, is that dividend sustainable? Can they continue to pay that in sustainable? And then what happens to cash received from sale of assets, and how are they retiring debt? Where are they getting cash to that? So again, cash inflows and cash outflows divided into operating versus investing, which is around fixed assets and long-term assets, and financing, which is related to things in the equity section, common stock, preferred stock, and long-term debt like bonds and notes. And so this is what happens in the financing. And again, payment of cash dividends, that will be an outflow. So dividing these, all the cash inflows and the outflows in these three sections tell a story about the company. Here's a cash flow statement. We're showing you an example of it. And by the way, this particular cash flow statement is done with the direct method. We're going to study both the direct method and the indirect method, but here's the, I'm going to require my students to be able to do the indirect method, and I'm going to gloss over, just so you know, the direct method. And that's kind of a contradiction, because the FASB, the Securities Exchange Commission, every time I've gone to a conference where these guys are speaking, they say, we want you to use the direct method in the cash flow statement. Stop using the indirect method. And, a lot of twiddling your thumbs by the chief accounting officers in the audience, because like 99% of the companies that I know, they use the indirect method. It's so much easier. And if you're going to use the direct method, you got to capture so much more information in your accounting system that would actually, not only be hard, but also cost money to gather. So, even though it's encouraged, most people do the indirect method. Now, direct or indirect, the only thing that changes is the operating cash flows. Everything else is the same, both in direct and indirect. So in the direct method, we looked at what are the direct cash flows. How much do we receive from customers? How about from investment revenue? How much do we pay to suppliers, to employees? So you might even have more of these, but it gets into direct buckets of how much we pay. So I could see why the SEC and the FASB want you to do it, because it would be good information, I think. And then you have to provide a reconciliation here in the direct method. And guess what? This reconciliation, it's the indirect method. So even if you do the direct method, you still have to do the indirect method. So you cut your work in half by just doing the direct method in the indirect method. In the indirect method, you start with net income and you make adjustments to get down to cash flow from operating. By the way, say this is really important. Cash flow from operations, the number doesn't change whether you use direct or indirect. It's going to be the same number. It's just what you're presenting in the information. So we're back to that age-old question. What is cash? And so, I would say cash and cash equivalents, to me, is to be whatever shows up on that line item on the balance sheet. And so we want to, make sure that we're reconciled to that. Now, restricted cash set aside for designated purpose, is part of reported cash balance, I guess. But if it's restricted cash, it is not part of cash and cash equivalents that we've studied. Now, again, we're going to look at all cash inflows and cash outflows. But if we go buy a 3-month or less treasury bill for $100,000, and these are both considered cash equivalents, cash and cash equivalents, has there been an inflow or outflow from cash? No, we've just moved from one cash account to another cash account. So that's kind of important to know. And so here, ExxonMobil, highly liquid investments with maturities less than 3 months are classified as cash equivalents. So they're letting you know what they have in there as cash equivalents. So here are the primary elements of the cash flow statement. Now I'm going to start with the 3 primary of the primary: operating, investing, and financing. Those are the three primary elements that we're going to do. I don't want to ignore these. Certainly you could be tested on these, but if you buy a factory or equipment for a note and you give someone else a note, payable or long-term notes, by the way, that buying that factory, that's an investing activity. That note would be a financing activity. But there's an issue. No cash changed hands. There was no cash inflow or cash outflow. So you, by the way, that's interesting. You do not put that in any of these three buckets, but you will disclose it. It's a non-cash investing and financing activity. So that's a required disclosure as part of the statement of cash flows. And then last thing, we're going to reconcile the beginning cash to all these cash flow ins and out from here to the ending cash. We're going to reconcile that to prove, I guess, if they don't add and subtract, you got an error, first of all, so, but we put that on the cash flow statement to prove that we have no error. So here's the direct method. We're going to, again, show cash flows instead of sales revenue. We're going to show cash received from customers. So it's going to be almost like an income statement, but only related to the cash inflows and outflows. And so, again, here's a direct method again. We show cash inflows from customers, cash outflows to suppliers, employees. So, I could see, again, why that would be a very useful method. But here we go. Here's what I will require of you and require you to prepare on the exam for me. In my class, maybe your professor does the same thing. The indirect method is called the indirect because we start with net income. And then we got two things we got to account for. Number one, what are the non-cash things in net income? If we had a gain on the sale of land in there, so this 12 would have been 4 without that gain. Well, a sale of land, that should be in the investing section, not in the operating section. So we're going to subtract that. Because it was a plus here, it's a minus here. By the way, if we had a loss on the sale of land sitting in there, we would add that back. So all these are the non-cash items. How about depreciation expense? That's a debit depreciation expense, credit accumulated depreciation, right? Any cash in that journal entry? No. Depreciation expense is a non-cash entry. So it reduces net income, so we got to add it back. Well, here I talked about a loss. Here's a loss that reduced that down to 12, and we add that back. So gains are subtracted, losses are added back, and then non-cash expenses are added back. Bad debt expense would be another one because we are debiting bad debt expense, crediting the allowance for doubtful accounts. That's a non-cash expense. We will add that back. Then the second section is we look at all the increases and decreases in the operating balance sheet items. I would say current assets and current liabilities. Now, maybe the current portion of long-term debt might not be in there because that would relate to financing activities. So if think about this, I'll say this, and when I do the problems for the cash flow statement, I have another little sheet, kind of a summary sheet that shows you maybe a shortcut way to think about this and do the cash flow statement that a lot of my students find helpful. But here, increases in assets, accounts receivable, inventory, that took cash to have that increase. Or like if accounts receivable increased, that means we had some revenues that we didn't collect. And so that is a reduction. Increases in assets are a reduction. Decreases in assets mean we sold some inventory that we may have paid for in prior years. That is an increase. Again, so these are where the pluses and minuses come in here for current assets. Current liabilities are the opposite. If current liabilities increase, then that means maybe we got some stuff in, we didn't have to pay cash for. And so that is, they work in the direct. An increase in a current liability is an increase to cash flow from operating. A decrease in a current liability is a decrease in operating cash flow because we are paying stuff back. That's why they increase or decrease. So this is indirectly, because we start with net income, we put all these changes in here, we indirectly get to what? Exactly the same number. No change. And by the way, the financing section and the investing section of cash flow does not change. So let's move forward. Cash flow from investing, this is about one thing, long-term assets. Are we buying them? Are we selling them? So if we're buying them, that's going to be a negative on the cash flow statement. By the way, here's one, that we want to be negative as investors. We want to see them we want cash flow from operations to be a big positive number. We want cash flow from investing to be a negative number. They're investing in what? Assets that are going to produce higher levels of net income in the future. And so what assets are we talking about? Long-term assets, property, plant, and equipment, maybe securities, maybe some non-trade receivables like a notes receivable. And then if we sell these, that becomes a positive, because when you sell a long-term asset, you're receiving cash. And so that becomes a positive to the cash flow from investing. Here is a cash flow from investing. Notice there's no direct or indirect. So this company has bought land, they bought a short-term investment, but they also sold land and sold equipment. And so, but they are investing. I'd be more interested, why did they sell this land? Why did they ever buy it in the first place? You'd really want to see a lot of negative numbers here and very few positive numbers. Or maybe they're making tough decisions and getting out of some land that they thought they were using and they weren't using. So again, the storyline is here in investing. Storyline for the future is what we care about. Financing activities. This is about long changes in long-term debt and equity. What's the story here? Where is the company getting the money to invest in the investing activities? Or even, you would kind of hope that all that cash flow from operation funds all the investments. Well, usually doesn't work that way. Companies are investing a lot more even than their cash flow from operations, successful companies. And so they may have to go out and borrow money. And so you'll see both cash inflows and maybe some cash outflows. Certainly cash inflows, sell of common stock and preferred stock. Remember, debit cash, credit common stock and additional paid-in capital. So bonds, debit cash, debit or credit a discount or premium, and credit bonds payable. So we have cash inflows when we issue a bond or sell common stock. Cash outflow, hey, remember our treasury stock transactions. We're buying back stock, debit treasury stock, credit cash. And so that becomes a cash outflow, maybe paying off debt. And then the one I love to see, payment of dividends to shareholders. You see it right here. How much did they pay? Here's cash flow from investing in this company. They sold some shares. They retired some bonds and they paid some cash dividends. Now this is what's the storyline here. Wow. They are issuing more equity and using some of it to pay off their debt. So they're going to have more, their debt to equity ratio is going to change here. It's kind of interesting. And they paid $5 million of dividends. Unlike cash flow from operations, I want to be positive, and cash flow from investing, I prefer to be negative. This, I just want to see, how are they financing their business? And so it could be a positive or negative either way in the financing section, depends on what the story is. And finally, we have to reconcile. By the way, this net increase in cash is cash flow from is the sum of cash flow from operations, investing, and financing. I say the sum of because some could be pluses, some could be minuses. That's going to equal to 9. And the beginning cash balance was 20, so 9 plus 20 equals 29. Let's just see if this works here. Cash, that's a +6. Minus 19, so right now, minus 13. Minus 13 plus 22, 9. So that's right from this example, the plus 22. That's why I always suggest people read your textbook, because you can follow these things right on the way through. Now that's where the 9 comes from. So the 9 was adding or subtracting cash flow from operations, investing, and financing. That's the 9. The beginning cash was 20, 9 plus 20. Okay, just showing to the investor, we've accounted for every dollar of cash in and cash out. And then the last piece here, as I kind of briefly referred to, we may have to disclose a non-cash investing. So this UBC acquired equipment by issuing a note payable. They didn't pay cash for it, so we'll just have a note there. Acquired 20 million using a 12% 5-year note. So it's not in the operating or investing cash flows. So they'll put that in there. So how do you prepare a cash flow statement? You're going to see that in my next lecture on this, the Part B lecture. But as long as I have an income statement and balance sheet, there may be some additional information I need. I can pretty much create and use a spreadsheet to create a cash flow statement. And so here's some pieces here. Amounts reported in the income statement are not the same as a cash effect. So this is a good example of why we add and subtract, accounts receivable. Sales receivable 100 million, but maybe they didn't collect all of that. And so we can see by the beginning and ending balance of accounts receivable that the cash received from customer could not have been 100 million. Some of the revenue must not yet have been collected. So if accounts receivable is going up on the indirect cash flow statement, that's going to be a minus. But again, these are also how you would create a direct statement. So here, let's look at this this example, because you definitely could get multiple choice on this, which kind of gets you back to a direct method. Beginning balance receivables is 30, and the ending balance is 32. During the period, there was credit sales of 100 million. How much did the company receive in cash from their revenues? That would be how the question would be reserved. A lot of times for me, I do a T account, because then I put it in pictorial. It's easier for me in my mind to work to calculate this. And I can come back and say, I got 130 in debits. What credit do I need to get to 32.98? 130 minus 32.98. So I know cash received from customers, 98. If I'm doing a direct method, that could go right on to the direct method cash flow statement. If I'm doing the indirect, notice what's happened here. 32, accounts receivable has increased from 30 to 32. So it's a +2. These credit sales of 100, they're in the net income statement, in the net income. So in the indirect method, I got 100. But this increase, I put it -2, I get to the same answer, whether I'm in the direct or indirect method. And that's why that increase in receivables in the indirect method becomes a negative. And you might have to think about that some more on your own. Same thing with salary expense. How much was the cash paid to employees? We started with salaries payable of 1. We ended up with 3 in the ending balance of salaries payable, and we had salary expense of 13. So I got 14 minus what equals 3? 11. This was the journal entry we did, 11. Here, I'm going to go back and talk about the indirect method. I think this slide in the textbook is for showing you how to do the direct method, but I'm going to talk about the indirect method here. Salaries payable increased from 1 to 3. So that was a +2. Salary expense salary expense was 13. So I'm just trying to think through this. Ending balance salaries payable. So I'm going to minus the 2, and so the actual cash paid to employees was 11. I'm going to think about that for a second. I'm going to have to think about that one and come back to it. Salaries payable. Oh yeah. So salaries payable increased. That is a plus to cash flow from operations. And so where this was a -13, this is almost losing it here. I did lose my spot here. All right. So salaries payable increased by 2 million. And on the cash flow statement, I'm going to tell you that becomes a positive number, that increase, direct method. Well, you know why? I got minus 13 in net income. But I didn't have to pay for all of this. So I'm going to add back 2, to get to 11. And direct method, we just put the 11, cash paid to employees. But I'm just telling you, in the indirect method, this increase in the payable means I paid less than what my expense shows, and I get to add it to cash flow from operations. Had a little bit of a brain problem there. Now, in the indirect method, again, we start with net income and we convert that back to a cash basis. Again, as I've showed you before, I don't want to spend a lot of time on this. We start with the net income, and there's that increase in accounts receivable we talked about, minus 2. And it's the same problem here. Where is that salaries payable? And there's the plus 2. And we look at all those changes in those balances, increases in current assets equal a reduction in cash flow from operations, increases in payable amounts, liability amounts, increases in a positive cash flow. I'm going to skip this slide because that will just confuse you, I think. Components of net income that do not increase. So there's some things that are in net income that are not cash related, like depreciation expense. And then we're adjusted for these changes in the balance to get to a cash basis. So we've talked about that. So in the indirect method, income statement have no effect on cash, but add to income, we deduct it. Deductions from income in the income statement that aren't related to cash, like depreciation expense, we add those back. That makes sense. And again, as I've been saying, increases in assets deduct from net income. Decreases in assets add to net income. Increases in liability, and again, we saw this in those examples, add to net income. Decreases in liability means we had to pay off some of those, deduct from net income. All makes common sense. And I have another slide summary sheet that may help on this. In the direct method, we still have to provide reconciliation and show the indirect method that it works. That doesn't get, if I'm going to do the direct method, I want some savings in time. I don't have to also do the indirect method. If I do the indirect method, I don't have to do that reconciliation. So, I mean, I wouldn't say we're lazy, but we're busy. And the indirect method is more cost efficient, certainly, to do. So most companies use that. And so with that, that is my last lecture slide. I do have a part B lecture on this where I'm going to actually create some cash flow statements, and you will see that. With that, I'm signing off on lectures for intermediate accounting, except for working the cash flow statement, which, hey, I love doing that anyway. So I hope you guys have, if you've been through all 21 lectures, oh my God, I owe you money, to listen to me that long, and I do. Thank you for attention. I just really, if I can really help 1 or 2 people, I'm going to be happy with that. I'm not doing this for any amount of money or anything anyway. So again, thank you for listening to this lecture, and I wish you the best in doing cash flow statements, both in your class and in the real world.